All right, everybody, I am going to go ahead and get started here. Let's see. Okay. So, as always, I'm Ryan Herbert. I think I know pretty much everybody on the call today. If you guys have questions, there is an area for you to type your questions in. If you send that in, just type your question and hit enter. Please ask the questions as I go along. I'll do my best to try and pay attention to it because it kind of hides itself as I'm talking. There is also a feature in there for you to use the chat, so you could send your question in the chat box as well. If you want to see the recorded version of this, I will be posting this video to YouTube, and you can always email me or Mike or anyone at the office to get a copy of this presentation as it is being recorded. So I'm just going to go ahead and get started. This is our quarterly market update for Prostatis. Today is April 18th, tax day. So I am taking a brief break from the last minute tax things we have to finish up at the office, file an extension, fix little things on people's returns, taking some time to kind of chat with you guys today. So I'll go ahead and get started here. This is pretty much our team. We have hired a new assistant. His name is Travis. Travis is replacing Alia, as Alia decided a couple months ago to pursue something else in her career. But if you have not met Travis, please feel free to reach out to the office and speak to him. We also have his bio, I believe, is up on the website, or if it's not up on the website, it should be up there shortly because I just saw it the other day. That is myself and Mike. We've been featured in a lot of different news articles, written some letters. Everybody knows we have our radio shows on 105.7 The Fan in Baltimore, 680 AM in Baltimore, and then there are 2 more radio stations down in Florida, and we actually just picked up another radio station down in Tampa. Obviously, this presentation is informational. Past performance doesn't guarantee future results, even though I don't think I talk about any of that stuff. But just kind of our disclaimer there. Really, this is kind of what Mike and I are thinking about, what we're looking at when it comes to how to formulate the overall portfolios, what the allocation looks like. If you came in and you had reviews anytime between really middle of January through now, I'm sure everyone had seen that we were in cash. We started going to cash a little bit in October, fairly good bit in cash by December of 2021. And then by the end of January of 2022, we were pretty much in all cash. And we just kind of been a little bit in and out of the market. You're really using that sector rotation to specifically target areas of the market. And right now, we are about 50% on the 50% of our equity exposure is actually out there in the market at this point, and then the other 50% is either bonds or cash, really depending upon which of the portfolios you fall into, from our all equity portfolio all the way down to our most conservative portfolio. That's kind of what the general makeup looks like. I want to talk briefly about the Secure Act 2.0 that is being talked about in Congress at this point. Some of the key points to it, if everyone remembers the Secure Act from a couple of years ago, really the big thing that it did was it eliminated the provisions for stretch IRAs, meaning you can't take your IRA when you pass away and your spouse passes away and it goes to your kids. They cannot stretch it out over their lifetime. They take it within a 10-year period. They got rid of that. And then they increased the RMD age from 70.5 to 72. So the Secure Act 2.0, what it does now is it says all new employees, except for companies that have 15 employees or less, would be automatically enrolled in the pre-tax contribution level of at least 3%, and it would increase annually by 1% up to at least 10%, but no more than 15%. That is an automatic thing that would happen. A bigger improvement for those of you that continue to work when you are later in life, typically, really what we're looking at here is everyone's aware of the catch-up amounts for 401ks and IRAs. Predominantly in 401ks, there's an extra amount you can drop into your 401k once you get over age 50. What they're talking about now doing is saying once you reach age 62, we're going to increase that annual catch-up amount up to $10,000 as long as you're working and contributing to your 401k, your retirement plan, your TSP, your 403b, whatever it happens to be between ages 62 and 64 beginning in 2023. That is if they pass this. It goes pretty shortly to be voted on fully, and then we'll see what it really looks like. Another thing is Roth matching contributions. Right now, any contributions that you receive from your employer for matching always go into the pre-tax account of your 401k, regardless of whether your money is going in there or not. If you're contributing all your money to your Roth, the Roth side of your 401k, all that money is going into the pre-tax. Now they're going to say, we're going to allow for Roth matching contributions. They're also going to allow employers to make matching 401 contributions based upon student loan payments. So really what that's saying is instead of, if you as the employee are not contributing to your 401k because you're making your student loan payments, we're going to match how much you're making in student loan payments into your 401k for you. Obviously, there's vesting rules and qualification rules, but that's kind of a new thing to really help kickstart younger Americans saving money for retirement instead of just dedicating all of their money to those debts. Another part of it is they're going to create a national database for Americans to find lost retirement accounts. You worked at a company for 2 or 3 years, 30, 40 years ago, you completely forgot about that 401k. Instead of having to comb through all those statements and paperwork and search on the internet, this database would allow you to just put your name in and say, all right, here's what's out there. It wants to give those 403b plans some of the design features of 401ks. 403bs tend to have a lot more restrictions as far as access to the money and what things you can do with it compared to 401ks. So they're going to allow for more freedom inside of those things. Part of the Secure Act said that 401k companies had to offer or had to show you an annuity option as to what that would look like. Now, TSP has been doing this for years and years and years. Those of you that have that TSP, on the front page of your statement over to the side, it says at age 62 or 65 or whatever the number is, this account could produce $1,523 a month. What it's showing you is here's what happens if you took 100% of your money and put it into annuity for an income stream. They want to make all 401k companies offer that annuity option, the ability to take your 401k or your 403b and turn it into your own annuity, basically making it your own private pension, getting a set dollar amount every single month. Like I said, allow Roth matching contributions. It's also talking about increasing the RMD age. And I'll get into that a little bit further. And it allows, and I talked about the student loan payment stuff. So the Secure Act 2.0 wants to push back that RMD age. They want to say the new RMD age will be 73 in 2023 for individuals who reach 72 after December 31st of 2022 and age 70, and you reach age 73 before January 1st of 2030, age 74 starting in 2030 for those who reach 73 after December 31st, 2029, and you reach age 74 before January 1st of 2033. And lastly, they want to push it back till 75, starting in 2023 for those individuals who reach age 74 after December 31st, 2032. Really, it is making it so much more complicated for you as the investor to pay attention to when you need to take your RMD and how you need to take it, particularly if you have money in 2 or 3 old 401ks, a handful of IRAs, and an annuity. Each of those has their own RMD rules. So you really just want to be prepared and make sure you know when your RMDs have to start. You want to make sure you're taking the correct amount out of your retirement accounts to make sure that you are not going to be penalized. Because if you don't take out the proper amount or you don't take out enough, the penalty is 50% of the amount that you didn't take out. So if you were supposed to take out $5,000 and you completely forget about it, you still have to take out that $5,000 and pay tax on that full $5,000. But the penalty the IRS is going to charge is 50% of that $5,000 RMD for $2,500. So you want to make sure you're aware of it. I like to joke, Mike and I like to joke that Secure Act, I think it stood for Setting Every Community Up for Retirement Enhancement Act. I got it right on the first try that time. Really just stood for securing an income stream for the IRS for the foreseeable future. And that is essentially what they are doing by changing these RMD rules. Most people view it as, oh, great, I don't have to take it. I can just let my money sit in there because I don't actually need it. Well, while that's true, what the IRS and the government are actually doing is having that money sit in there longer. For those people that don't need it, let it sit in there for another 3 years now. Instead of 70.5, now they want to make it 73. Let it sit in there for another 3 years or 4 years or 5 years, depending upon your age and when you're going to turn those ages. But that money is going to continue to sit in there and grow and compound over time and become a bigger amount. And then the older you get, mind you, they're changing the ages in which you have to take the money out, but they're not changing the factor that determines how much you have to come out. And every year older you are, the smaller that factor becomes, so the number has to come out. Because what we do is we take the December 31st value, look at your age. For age 72, I want to say it's 26.8. Divide that December 31st value by 26.8, whatever that number is, comes right out. Don't quote me exactly on what those numbers are because I haven't looked at those tables in a little bit here. But every year older, the divisor gets smaller, so the number gets bigger. So now they're saying, let's leave this money in your IRA, your 403B, your 401k, your TSP. Leave it in there. That's fine. Leave it in there. Let it continue to grow. Oh, by the way, now you're older. We're taking a much bigger RMD amount. So really, you know, what we've been trying to do with our clients is doing these Roth conversions, getting the money out of your IRAs, your 401ks, your TSPs, and into Roth accounts. That way the RMD rules don't apply to you, and that money can stay in there and grow and grow and grow. And what we're trying to do is make sure we get all of that money out before you hit that RMD age. Right now we have 22, 23, 24, 25, 4 more years of the Trump tax cuts where we have these really, really wide tax brackets, meaning how much money fits into all these percentages is really wide, and the percentages are lower. Because at the end of 2025, those brackets shrink back down and those rates go up back to the Bush level tax cuts. That's really kind of what's going on in the regulatory world. To talk more about kind of what is going on, this is the chart that I showed everybody towards the end of last year, early January, my last quarterly market update. And really what it showed here was what the thought process was for the number of countries that were either going to grow and accelerate in their GDP, grow and decelerate their GDP, contract and accelerate GDP, or contract and decelerate their GDP. And really what it was kind of showing us was it was about 50-50 really. There should be a large amount of companies that continue, or a large amount of major economies of the 45, about 50% of them were going to grow their GDP and continue to accelerate their GDP in a rapid manner. And then 50%, the other 50% were still going to grow their GDP, but not at the rate as it has been growing. And that's really not what has happened at all in 2022. It really has been a volatile year, a lot of up, down, sideways, a pretty big slide from October, the height of the market, all the way down to March, which was, kind of what is right now is the bottom of end of March, the bottom of the slide at this point, because it has started to rebound a little bit. But really what we have seen is investor sentiment. I talk a lot about investor sentiment. It can be a contrarian indicator, meaning that this is the American Association of Accredited Investors investor sentiment survey that says how many of these investors are feeling overall bearish. And when we have a high bearish number, typically what it's saying is really the market should be a bull market. And when we have a low bearish expectation, which is kind of where we are now, this was 2022, we had our bearish sentiment really pop up in February when Russia invaded Ukraine. It surged up to almost 55% of the everyday investors feeling bearish, and now it's kind of fallen off. Really, what it's saying is the pessimism that the overall investor has in the market has retreated, but really could be a setup for more weakness in the market as really the overall investor lags behind kind of what the stock market's going to do. Right here, this is short-term breadth of the market. What this means is the percentage of stocks on either the S&P 500, the NASDAQ, or the Russell 2000 that are above their 50-day moving average, meaning they're trading a lot higher than they were now versus the last 50 days. Really, we have seen a pretty sharp increase from March as far as the number of stocks on either the S&P 500, that's kind of leading, and then the NASDAQ, you can kind of see the yellow in here, and the Russell, as far as the number of stocks that are really trading over their 50-day moving average. So really a short-term looking indicator, certainly much more robust than the anemic percentages we had down here, really looking early March, 10, 15%, 20% of the companies there. As of right now, kind of what we're looking at, the more longer term look, this is the 20-day moving average. This is kind of where we started to see our slide really in the market was October, and it started to kind of fall down. You can see that the number of companies that the stocks above their 200-day moving average on the Russell is about 35%, the NASDAQ about 30%, and then the overall S&P 500, how many of the stocks on the S&P 500? About 50% of them are actually trending positive over the last time frame. Really kind of what that's saying is in the short term, stocks are looking good, but in the long term, really it's kind of showing a little bit weaker. Really, we haven't seen the overall market. The S&P 500 is doing decent, but the NASDAQ and the Russell 2000 really are lagging behind. Another hint of weakness has really shown up in the S&P 500. Really what it's showing is traditionally the defensive areas of the market which are utilities, real estate, and then consumer staples right here. They really are experiencing really strong participation of their members. So, the utility sector, 97% of the stocks on the utility sector are above their 50-day, 96% above their 200, and that's kind of what this is showing for consumer staples, 75 and 75, and real estate is 90 and 83. Really, it's kind of at odds with the lack of strength that we have in the traditionally cyclical areas that typically do well this time of year, which is financials. Only 49% of them are above their 200-day moving average. Materials, only 50% are above their moving average, and industrial. So the stocks that are typically performing really well this time of the year are not performing as well. Really, energy, I mean, you guys saw in some of the sector rotation that we were doing throughout February and March because of what's going on in Ukraine. Those sectors are doing really well, unsurprisingly, really because the surge in oil prices earlier this year that we saw because of the Russian-Ukraine invasion. One thing that I talked about way back in March, April, June, May of last year was the large number of stocks, the largest tech and tech-related members in the S&P 500 by market cap, those companies that make up the biggest percentage of the overall market, they're called really the Super 7, really kind of drew the entire market up when they were doing really well. And then they really haven't gone anywhere, Tesla being the one that moves the most. From the last 2 years, those stocks really haven't moved a whole lot. Really what we've seen is the drawdown on these has fallen down a lot from October to March. You can see almost a 40%, 50%, even, over 50% drawdown in Meta, which was Facebook. But Apple, Google, Microsoft, Amazon, Tesla all saw a pretty big drawdown. And now we're seeing a pretty big rebound in those stocks. So as those stocks start to lead the way, the rest of the market, in theory, should follow along behind it because that is what we saw in 2020. Hopefully, this is kind of showing that the worst of it is behind us, but it really is all about the rebound that we really see. This is really what we saw in the S&P 500, the NASDAQ, the Russell 2000 from the end of the year all the way to what is, really the trough, the bottom of the S&P 500. And now we're starting to rebound across all the indexes, which is why you have seen the portfolios have slowly started to increase their equity exposure at this point from that point on. So that's kind of where the direction of the markets are going. It is going to be volatile, and you're going to see small increases of equity exposure back into the markets. Overall, the portfolios held up pretty well in this overall drop. I want to say the overall drop from January to that trough was about 15%, and the portfolios themselves were down anywhere from 4 to 6% over that same time period. So well over less than half of what the overall market was at that point. Really kind of what we're seeing leading the way again is the most speculative stocks, the most low quality areas of the market really have been outperforming. Those non-profitable tech stocks, those meme stocks, the SPACs, those are IPOs brought to the market, not in the traditional sense. And stocks that are typically really heavily shorted by the big institutions have shown much stronger gains than everything else out there in the market, really some into double-digit percentages. And really, I did talk about this during our last market update, is that the amount of money that has flowed into the younger generation's hands over these past 2 years has been fairly substantial. We suspended student loan interest. We gave out all these tax breaks to younger kids. I'm going to call them kids. The younger generation that was sitting at home working from home, they took all that money that they weren't having to pay down their debt. They took those stimulus checks from the government and they put it into the market. And they just looked and said, here's what the overall institutions are doing. They're betting the stock is going to go down. Let's bet against them and drive the price of the stock up. That's what happened with GameStop, AMC, and those overall meme stocks. Really kind of what we see is this is kind of what has really been leading the overall drive in the market. Our non-profitable tech stocks, those are doing have started to rebound. The meme stocks have rebounded. The stocks that have been the most shorted, big institutions betting those companies are going to go down, those have started to rebound. So this is something we need to pay attention to. This is why we have that momentum factor in the overall portfolios to be able to capture what is going on, because technically and fundamentally, these are not the areas of the market that you typically want to be in, but the overall momentum is there. The portfolio does allow for us to get some of that exposure to those meme stocks and the other momentum-driven stocks from that perspective. The outperformance in those areas may really does seem like the low quality rally is really concentrated. But if we look at the overall market, really the Russell 3000, the chart still holds, kind of what I'm thinking. Really what we're seeing is the trough, the performance over 2 periods, the peak on January 3rd of this year to the trough of March. So really kind of what we have, this is our earnings per share. This is from January of 2022 to March 14th. We had negative earnings per share, but it really kind of starts to die out. And then the same thing as far as earnings per share, positive gains is kind of what we're seeing, what we saw, and it started to die out. Really, earnings per share has started to slow down. Really, it's showing us that there's a reversion coming in the overall market, where those short, poor quality stocks are not going to be leading the way. We're not going to have this new era of low quality stocks really leading the overall market. We are going to have a revision back to the mean, and those high quality, highly profitable stocks really are going to start to show what's going on from that perspective. Historically speaking, those lower quality areas of the market, including those non-profitable companies, have shown leadership in the overall market when we're expecting accelerating economic growth. And I don't think anyone really thinks at this point is we're going to have accelerating economic growth with everything that's going on. This is the overall market, really kind of what we've seen, the overall index as far as its drawdown over that time period. Airlines, this is the huge drop we saw in the airline industry. Auto components for auto producers, that's kind of fallen down. Our building products has come down there, our drawdown. And now we're starting to see those rebounds in all of that. The economically sensitive areas, that's the auto components, the household durables, airlines, building products, and banks, really do not hold up as well as the overall S&P 500. We think that earnings will start to matter more in the coming weeks and the coming months, because first quarter reporting season is about to start, and we should see the profitable companies that really take hold with positive earnings per share those companies are we're going to start to see rebounds in those particular areas. And that is kind of what you're seeing with the positioning of the portfolios at this point. It's really broad market holdings and a few targeted moves in the overall portfolios from that perspective. The U.S. economy it continues to look at look for a risk of a slowdown. We have extremely high inflation, the unknown impact of higher commodity and energy prices, really what happens with that. Demand is starting to soften in the United States, so economic growth is kind of questionable. The Fed has really started to tighten that monetary policy to try to control inflation. Really, that's them saying, hey, we are going to start raising interest rates. And if everyone thinks about talking with Mike and myself and Catherine of, here's why we don't want to be in traditional bonds, because we can buy these bonds now that are paying 1.2%, but over the next 2-3 years, the Federal Reserve is going to start raising their interest rate. As the interest rate rises, the prices of those bonds fall. So that safety net that you're supposed to have in bonds, of when the stock market goes down, I don't lose anything. I just I earn a small percentage. And when the stock market goes up, I might earn 2, 3, maybe 4%. It's not traditionally there, because as they're raising interest rates to help control inflation, raising interest rates is typically viewed bad in the overall market and could possibly cause a pullback in the market. Well, if the market is dropping and they're raising interest rates, I'm losing money on my equity side because the stock market's going down, and I'm losing money on my bond side because they're raising interest rates and my bonds aren't worth as much. That is why we are using that overall bond replacement strategy with pretty much all of our clients. Because the Fed raising those interest rates, trying to control inflation, really just adds to the pressure. For now, we have higher prices and slowing demand in the economy. Really what has happened is prices have risen so fast, so quickly, that it's done it in such a way to slow the economic growth. The higher prices really has taken its toll on demand. Really what I have here, this is the ISM, Institute for Supply Management, March Manufacturing Survey. What we have here is that new orders on both areas of the index, the manufacturing side and the service side, really have started to slip over the past year or so. Here was 2020. We had a fallback and we had a surge in demand for manufacturing, but it really has fallen off. These levels, the one thing to note is the levels of new orders for new manufacturing and services has now fallen into the same range of what we saw consistent with the recession that started in 2007. So I'm not saying that is what is happening. That's what's going to happen. Certainly a lot of the technical and fundamentals that we've looked at over the years have not stuck true. Case in point was 2019, where we had an inversion in the yield curve, meaning that if you were to buy a 10-year treasury, it paid less interest than if you bought a 3-month treasury. So you would think, if I'm going to put my money away for 10 years, I should certainly get more interest than if I'm going to put my money away for 3 months. Historically, anytime that ever happened, we had a recession. That didn't happen. That was the end of 2019. What we saw in 2020 was not a result of the inversion of the yield curve. It was a result purely of COVID. So this is just really something that we should be looking at, something that Mike and I are keeping an eye on, which is why it's not full throttle, full force into the market with the overall portfolios. It is a slow and steady approach, just in case this is what is happening. The supply chain is getting better. A lot of what I think is attributable to this record high inflation really has been supply and demand and the supply chain issues that we saw in 2020. Really, the global stocks have started to rebound to the pre-Russian invasion levels, but they do remain lower. Still concerns about inflation. The overall rise in prices has been driven by the inability of our supply chain to keep up. Those are the supply chain issues we've had. If these supply chains begin to get better, the potential for a slowdown in inflation is certainly there. Supply chain conditions seem to be moving in the right directions for the past several months. Manufacturers have been indicating that the time it takes for them to deliver their product has started to shorten, and that the backlog of the orders that they have, their ability to fill products has started to fall as well. So things are getting better. These two things are moving in a positive direction. There are certainly areas of the market, certainly areas of the economy where they're not getting better, but overall, delivery times are improving for manufacturers, and the order backlogs are falling. They're getting caught up. They're being able to produce everything they need to produce. Is the worst of the supply chain issues behind us? That really remains to be seen. You know, really what this is. Red is bad, green is good. The number of COVID cases in the world really peaked, it seems like, in January, and is now starting to fall back off. China, on the other hand, things are getting much, much worse. You can see we had a lot of red as far as the delivery times, and I kind of showed that. Now we're seeing, instead of having these red delivery times like we saw throughout early 2021, now we are seeing some lighter colors kind of getting more to that green. The volume of what is being shipped, really the only bad area that we're seeing is China. The volume is not good in China. The prices of goods is staying fairly consistent. The price of actual shipping is staying fairly consistent. There is some things falling off. And really overall inventories are starting to get better. Manufacturing purchases, the companies that manufacture the products for other companies to assemble them, that is starting to get better. So overall, it does appear, barring any major issues, any larger COVID outbreaks, China not getting too terribly worse, it does look like the supply chain shortages are behind us, and inflation should start to come down from that perspective. So overall, really the overall approach that we have at Prostatis is a broad market approach with some targeted positions that we may take through our sector rotation side of things. I want to make sure everybody saw the email that went out last week talking about the I-bonds from the federal government. I happened to be on vacation with my daughters last week, and I was just checking the news on my phone, and I saw 8.3% is what the I-bond is offering. If everyone remembers, back in December, January, we reached out to you and said the federal government's offering an I-bond paying 7.13%. That rate is good for about a year. Those I-bonds, the maximum that you can put in is $10,000 per year per person. So if you haven't done it, I recommend you go out and do it. Those rates are adjusted by inflation. They change the rates every 6 months. I don't see inflation getting drastically better over the next 6 months to a year. I do see it starting to come down. But you know, if you have a significant amount of money sitting in your bank account, more than 3 to 6 months worth of expenses, this is something to look at. It is only $10,000. So if there's other cash over and above that amount in your bank account, there are some alternative strategies that we can utilize for you in your portfolios. Really what these I-bonds say is they can be cashed in every 6 months. If you cash them in before 5 years, they charge a penalty of 3 months worth of interest. If you're earning 8.3% on $10,000 and you have $100,000 sitting in the bank earning 0.003%, this $10,000 is going to make more money over that same time frame, even if you pay the penalty by cashing it in early, than you would on $100,000 in your bank account. If you have any questions on that or anything else that I talked about, please give me a shout. You can shoot me an email or give me a call at the office, 410-863-1040. I am wrapping up tax season today, and I probably should have a few stragglers over the next day or so. So do allow me a little bit of time to get back to you. But if there's something I talked about that you have more questions about, please just give me a shout in the office. Since we're wrapping up tax season, review time for all of our clients coming in the office and talking about everything that happened in the portfolios and what's going forward. That should be coming up for you over the next month or so. So thank you, everybody, for listening to me. And I hope to see everybody off. I hope to see everybody in the office soon, and have a wonderful afternoon and a wonderful rest of the week. Thank you, everybody, and good night.